Hello and welcome to the Monday Futures Market Outlook for February 19th, 2013. This is Patrick Srezna. All of the content we cover in this video is put into written form in our Market Timing Strategist newsletter. Visit the website to get some further insights. As always, we start off with the chart of the US dollar index futures. We have here a chart that has really found a short-term bottom, largely by the fact that the euro has hit such a key high. We do not believe the environment is there for the US dollar to substantially weaken below that major support line, and which means that we were just coming off a compelling risk-reward proposition, something we've talked about over the last month in our videos. Really at this stage, now that we're approaching a short-term key high, we may not have immediate follow-through, but we remain optimistic that the US dollar has room to still yet strengthen. At minimum, at some point over the month of March, we would expect the US dollar to even reach as high as that 81.75 focal point up above, and even throughout the year there's room for it to return even back towards the 83-84 highs that were put in the summer of last year. One way or another, we're right now just waiting to see how a little bit of a pullback occurs, and then where the basing occurs for the next good buying opportunity on the dollar. Next here, I'm pulling up a chart of the euro, and the euro strength has been very pronounced over the last 6 to 9 months. The euro strengthened all the way to a high of 137 and has since receded back. Very rarely is there a topping formation that develops without there being numerous retests, so there's room at this point for the euro to make it back up toward those highs again for confirmation, but we do actually believe that these are levels where there could be a potential euro top. This is one of the reasons why we believe that there is room for the US dollar to strengthen, is because if the euro begins any retracing back towards 131 down on the downside as well, it could even weaken as low as the 127 level during a more robust sell-off, in which the US dollar would do relatively well. So we're going to watch to see how the euro continues to consolidate here. Next year, I want to take a look at the 30-year Treasury bond. And while those of you that are subscribers to our Market Timing Strategist newsletter would know that we, in general, are quite concerned about the mispricing of bonds because of Fed manipulation. And while that's a very big picture outlook, on the short term, there is actually a technical bottom potentially forming. And I want to say potentially because we have yet to see any technical follow through on the upside to validate it. We are at a key support line along these lows, and we've finally seen some sideways consolidation. If these bonds begin to show strength, particularly accompanied by US dollar strength, that could be a dangerous combination for the stock market down the road. One way or another, we'll be watching to see whether a bottom forms here. When we tried to do this, find a bottom like this on gold, it didn't work out. So I want to make sure that I emphasize that even though we think that this could be a place where bottom occurs, the price actually needs to confirm by breaking higher in order to be validated. Next year, let's take a look at some of these commodities. The first one here I want to take a look at is copper. And copper has put in a short-term high because of the degree of the selling that's occurring throughout the day. Really at this stage, we've been looking for copper to remain very range-bound, and simply identified that the risk-reward proposition of copper was really bad last week because at that moment we only had a marginal upside for a substantially larger downside risk within this range. And so we were actively suggesting that to step on the sideline. We're not necessarily outright bearish copper, simply observing that copper will likely trade to the bottom in its range. Short-term traders can certainly try to capitalize on that, but we are certainly not buyers here. Next year, I want to take a look at crude oil, and crude is consolidating at a major peak level. Last week, we just had a retest of the highs, and again, another rejection off of that previous high. We are starting to see a little bit of overhead resistance here, and so long as there's a strong U.S. dollar and weak commodity environment, crude oil can potentially break. We're going to wait for a legitimate signal below the 95 level on the downside before really suggesting that it's a new downwards consolidation has begun. But if it does, then there's plenty of room for crude oil to weaken all the way back down toward $90 a barrel in the upcoming weeks or months, as especially if it's again confirmed by a stronger U.S. dollar. Next year, we want to take a look at gold futures, and we were actually suggesting earlier that gold could have put in a bottom at that 1650 level, and we were cautiously optimistic that that support could have held because it held for so long. But we were suggesting that we needed a confirmation with a break above 1700, similar to what kind of confirmation today we look for in the bond market. Really, at this stage, with gold having made this breakdown move, it really opened the window for the gold to have to find a new level of support. Really, at this stage, there is some initial support in the 1600 to 1575 zone, but the major lows of last year in 2012 occurred all the way down at 1550. So at this juncture, there is vulnerability to even up to $15 more of per ounce downside before we could see some real meaningful bottoms. At some juncture, when we're looking at the commitment of trader reports and all the sentiment that's associated with it, we are probably going to see a major bottom in gold at some point. But really, at this stage, it is far too premature to speculate anything. Let's let the initial wave of selling here finish off, find out where everything settles in, and probably sometime by early to mid-March, we can really start to see where the opportunities for gold will lay. So finally, when we take a look at the S&P 500, we had a material break above that 1505, 1510 zone where we was the top end of some of these consolidation zones. Really, at this stage, with a break to higher highs, we're going to be seeing the market attempt to go even as high as 1550 on the upside of the S&P. We continue to be very adamant that it is a bad risk-reward proposition being in this market. It doesn't mean it can't go higher here, and it also doesn't mean that there's a market crash imminent, but rather there are those key moments in the market that represent good buying opportunities and ones that represent times to be actively selling into strength and distributing. We believe that there's still a topping formation that may have to develop, which means even if we hit peak levels in the market this week and even saw 1525, 1550 on the upside, we could probably spend still many weeks testing those zones up along the upside before a really meaningful corrective pattern kicks in. There's a lot of people during these kind of methodical rises that always put the question as to whether or not a correction ever will occur. And I want to put that to bed. In the history of the stock market, there has never been a rally that hasn't at some point led to a subsequent market correction of the rally. Corrections are a very necessary and important part of this whole process. So a correction will at some point come. It's just about when it will come and off of what level. And really at this stage, we think that with the market still breaking to higher highs, that this whole process can still be prolonged even for another 3-4 week cycle. We don't think that anyone needs to panic sell out of the market, but selling your stocks into good strength and into taking nice profits into good things is good strength is a very good exercise here, and we'll be looking for some sort of a legitimate market correction to rebuy into the markets. Just to summarize our key intermarket observations, we actually think that the risk-reward propositions of U.S. dollars and bonds are actually pretty good compared to commodities and both U.S. and global stocks. Really, at this stage, that doesn't mean that the trends in place are not well embedded. Like, for instance, stocks continue to be very clearly an uptrend. So please do recognize that when we say the risk-reward proposition is poor, it's not that the trend is down. The trend is clearly up, simply that the amount of risk we're taking to be trying to make a little bit more out of the market is simply a bad proposition. I was even contemplating moving that to a very poor rating, but don't want to use that last bullet yet, just in case the market still does have a further rally in the next week or two. But we are actively endorsing the profit taking of this market. That was your Monday Futures Market Outlook. Thank you for joining me.